Hello, investors. It's Don Vandenbord, Chief Investment Officer with Revere Asset Management. Today is Monday, February 24th, 5:07 p.m. Eastern Time, coming to you from St. Augustine Beach, Florida, with the Revere Roundup Daily Market Insight video. Market state, we're in a short-term pullback. Check the trend gauge over here. On Friday, we took market leaders down to red as they just completely came apart. Started Wednesday, accelerated Thursday, got even worse Friday. Didn't do any good today either, but we're all out of individual names. We were as of Friday. Short term, all the major indexes below their 21-day moving average. So Friday, that arrow went to red as well. Medium term, we've got a mixed bag here. The Dow, small caps and mid caps are below the 50-day moving average. S&P 500 and the Nasdaq 100 got their first close below there. We normally wait for two closes below to move the arrow when we're down to just the S&P and the Nasdaq 100 as we weight those more heavily. RSP, equal weight S&P, hanging on to the 50-day moving average. So green there, but a red sub arrow. Long term, small caps, the only index below the 200-day moving average. So green arrow there, yellow sub arrow on long term. Market never gets into serious trouble until the S&P 500 starts to break the 200-day moving average. We're about 5% above that level right now. So short-term pullback market state isn't it worse than that? Well, it is if you trade individual growth names, but you should have your stops in place to get you out of those. The S&P is less than 3% off of the all-time high that was just set last week. But very clearly things changed the middle of last week, got worse late last week, and today was no help either. So what happened today? Little gap up at the open that just served to suck some bulls in before the rug pull. We set the high of the day within the first 5 minutes. Uh, Broke down pretty hard below the 6,000 level. Little bit of a late morning bounce and regained 6,000 into the early afternoon before rolling over, uh, working our way slowly lower into the close, and then Trump reinforcing Mexico and Canada 25% tariffs. Today, the market sold off into the close there, and that took the S&P 500 and the Nasdaq 100 below their 50-day moving average at the close. Not very good. So here are the numbers. 21-21. There are no leaders. There are a few survivors. So we're marking this under construction. There's no sense trying to throw a couple of or a handful of remaining leaders that have lost less and are still languishing above their 21-day moving average, and tossing a bunch of staples and drug stocks that we have really no intention of buying. So until there's a proper list of growth names that can do double the S&P 500 in an uptrend, we're going to keep the 21-21 under construction. We'll talk about names that are getting added to our list that we like, and names that are showing relative strength. But for now, there's no sense calculating a 21-21. The big eight down 1.42%. The RG8, I'm going to talk about this in a little bit about how how this started back in 21-21. February 21-21 was a very similar period to what we're seeing right now with growth names. They broke down mid-February. Then it was because the 10-year broke out of a certain level. Interest rates spiking up scared the market. People cashed in the chips that they made in 2020 post COVID, and there was a stealth bear market in small caps. And we're seeing pretty much that right now. But the RG8 down, all eight of them down an average of 1.11%. The S&P 500, I said it opened up a third of a percent, closed down a half a percent. Equal weight S&P slightly green. We'll take a look at the rest of the indexes when we go through the charts. Global 60/40 down a third of a percent. Our flagship GROTECTION portfolio down a quarter of a percent. So let's get into the indexes. and we'll start here with the S&P 500. You can see the new high last Wednesday. Decent close on Thursday, although we were down. Broke the 21 on Friday, broke the 50-day and that 6,000 level today. Not good at all here. So let's go to the 60-minute chart. Um, Ironically, although we broke the 21 and the 50, we're still just at the bottom of this range that we have been talking about for 4 weeks. But a failed breakout, very often from failed moves come fast moves. And you can see how fast we've gone from the top of the range to the bottom of the range there. And this actually looks constructive. If you're looking at something like FFTY, uh, here's a failed breakout for the ages. Breaking above last week, look how this has come off and gone down near the lows from January. And this is a part of our RG8, 8 growth ETFs. It's a composite that we track. Look at how this has come apart over the last new high and then reverse, and then 4 days of selling. On the back of that, bounce at the 200-day moving average. Most of the RG8 look at this, and we're going to flash back here in a moment to 2021, and you can see history repeating itself. So that was the S&P 500. Let's take one more look at it. You can see there below the 6,000 level. Next area of interest for us is the 100-day moving average. Still rising. We're coming into that level. NASDAQ 100 with the late weakness. The 21 EMA has also rolled over here and a close below the 50-day moving average. Let's go to the big cap Dow Jones. Sitting on the 100-day moving average, two closes below the 50-day. Let's go back to the S&P and look at the equal weight. We've got the slope of the 50-day moving average trending lower. The reason for that is this huge sell-off in RSP. What we saw in early December was a bunch of selling in staples and defensive type names, while we had some decent moves up in some tech names. So we've got the slope of the 50-day moving average turning lower. We're above it, but you could stay above it and ride this lower, and that's not healthy. Note the 1 week relative strength line pointing up over the past week. The relative strength line pointing up for equal weight S&P, and that's just because the value half. Let's take a look at SPYV value. That's a pretty decent looking chart sitting right on the 21. Let's take a look at SPYG, the growth half breaking the 50-day, coming into the 200-day. Value far outperforming growth, as we've been pointing out. On to mid caps. Undercut but closed right on the 200-day moving average. Small caps, and we're using the Russell 2000 for that. You can see that the 200-day moving average, we closed below it, tried to get back above it early. That was feeble, and we made a lower low below the 200-day moving average. So obviously not a good sign there. Let's move on. Interasset correlation VIX with a second day spike. It's near that 19 level. We don't want that. We'd like to see it around 16. And the S&P 500 ATR ticked above the 1% level today, and it'll be rising after today's wide range. That's also something we don't like to see. How about the US dollar? Bounced at the 100-day moving average, just barely up today. Precious metals, here's gold making a new all-time high. This is one of the two ETFs that are sector plays that we own. GDX gold stocks bounced at the 21-day moving average. We sold our NUGT, which is how we were playing this. We sold that on Friday, booked the gains on that. How about Bitcoin? Failed at the 50-day moving average on Friday, down near the lows of this 3-week consolidation. This whole base has been 43 days long now, and the 100-day moving average is coming up into the bottom of that. Excuse me. On to bonds. Broad bond index up slightly, TLT. Long bond up slightly. That means yields down just a bit. There's the 30-year, and there's the 10-year. So let's take a look. Excuse me. First, let's move. I got a six ETF list here, six dividend ETFs. Why are we looking at dividend ETFs? Well, we're always looking for what's outperforming, and I can pretty much guarantee you that if growth stocks are lagging, that dividend stocks are going to be outperforming. So let's do a little exercise here. A Market Smith comparison chart of I want to do it for these five dividend ETFs. Okay. Let's set the date back to when the market chopped in 21-21. It was February 12th. So we're going to set the date here to February 12th, 2021, and we're going to set the end date. There was let's go with the end of April. And what you're going to see here is nice returns here for these five uh, dividend ETFs over this period of time. So basically, it's about 2.5 months. Now, the RG8, let me put a couple of symbols on here and you can compare their action to the action of this. So this is small cap growth. Here's the IBD 50. Here is Kathy Wood's ARK-K. This is what we saw. It's kind of similar to what we're seeing now. Here's three of the RG8. They sold off terribly starting in mid February of 2021. They went down to the first or second week in March before having a little bit of a bounce. This is a extremely weak seasonal period that we're seeing right now, but weakness and decimation are two different things. If you're in growth stocks, we've pretty much seen decimation the last 4 or 5 trading days. So these ETFs, this is something that we're evaluating right now as a place to possibly put some money in and get a little bit of outperformance. And here's why I want to show you that. Let's go where the S&P 500 is here, and let's compare that to the growth half of the S&P 500 underperforming, and let's put on the value half of the S&P 500 outperforming. So the value half of the S&P 500 during this period that I have up here with all these growth ETFs doing between 10 and 14.5%. The S&P was only up 6%. The growth half of the S&P up 3%. The value half up 9.5%. While these growth ETFs, which correspond to this is the pond we fish in. We want these names to be doing well, and they certainly weren't back in 2021 during this period, and they certainly aren't now. Let's take a quick look at the RG8 and those three. We'll go back to present day here. Here's IWO breaking the 200-day moving average. Here's FFTY with that huge failed breakout, bouncing at the 200-day moving average. Here's ARK-K holding up better, but still broke the 50-day moving average, but you can see the heavy volume selling over the last 3 days there. So the point here is that value and dividend stocks are outperforming right now. This isn't the pond we fish in. So what we do is put our portfolio back. The only thing we're holding right now is S&P 500 index equivalents, a little bit of Bitcoin, and about 2.5% gold. We're looking at possibly adding more to gold, but we keep our beta closer to under the 50-day moving average. We want it to be closer to a 0.5 or half of the overall market while the market figures out what it wants to do. Does it just want to go down to the 20-week or 100-day moving average and then right itself? Obviously, all of these growth names are oversold and their charts are broken. So they're going to have to form some bases. And it's just a matter of watching the money move around to see where it comes in. But we're not chasing out performance right now. We're basically treading water is what we're looking to just stay in sync with the market with a lower beta until the market makes its next move. There's a lot of uncertainty with tariffs, rate cuts ticked up. There's inflation concerns, and there's an inflation report on Friday. So we'll be keeping an eye on that. So let's take a look at a couple of names that are holding up pretty well. Some we've owned in the past and we may consider owning here. Eli Lilly. It's a drug name, but it's a growth name. Look at these numbers here. and it had its big pullback, formed a nice flat base. It's putting in a little bit of a handle here up near the top of it, but this is certainly something that can be owned based on the relative strength and the growth prospects of it. Let's take a look at another one. This is a turnaround play. They love the CEO, Brian Nickel, at Starbucks. He's got a great track record with Taco Bell and then with Chipotle. Serious relative strength here, 24% growth into fiscal 2026 and gapped up on earnings and continuing to go higher. Seen a lot of gaps up in earnings. If they're tech related, for the most part, they failed miserably. This is one that's still going. So Lilly, Starbucks, and let's take a look at Ferrari race. If there's a recession, there's not a recession in the ultra wealthy. You can see this formed a nice flat base here and is putting in a handle right above the pivot point. So those are three names with either a story or the N in CanSlim or decent fundamentals that would be on a 21 over 21 list as being under consideration to buy if we had one, but we're not looking to buy right now, and that's because of the overall market. The reminder, of course, is that our flagship portfolio is named GROTECTION because it's designed to grow assets during uptrends. Well, that uptrend seems to have hit a little bit of a stall. When that happens, we start lightening up. As you've seen, we did. We detail it every night in the video, same as we did in December, same as we did last July. And we wait for the winds to shift from headwinds back to tailwinds so we can take advantage of a strong market because growth stocks in a strong bull market outperform by at a minimum of 2 to 3 times, and some of them can really blow those numbers away. So we look to focus on them. When the market is working, it is not right now. And with that, I'll wrap it for Monday, February 24th. This is Don Vandenbord with Revere Asset Management, telling it like it is. Reveritas is the word of the day. Revere and market truth. Combine revere with the Latin word for truth, which is veritas, and you get what we put out here on video every day. Just the truths about the market, no opinions, telling you what's actually happening. And it's based on the rules of William O'Neill historically. And he used to say it all the time. This is just how the market works. And with that, I'll wrap it. Thanks for listening and have a great day.